Hi, I'm Michael Wong with Long-Term Care Resources Pacific, and I want to share a few things about long-term care planning that most people have never heard of, but really should. A quick bit about what we do. Our company partners with alumni associations and professional organizations to help their members plan for long-term care. In other words, to prepare for the kind of care people might need later in life without putting a strain on their family or their savings. I grew up here in San Francisco, went to school in the Bay Area, and now I get to help people in our community find smart, affordable ways to protect themselves and their loved ones. So let's start with what long-term care actually is. It's not medical care like surgery or doctor visits. It's the kind of help you need when you can't do certain everyday things on your own anymore, like bathing, dressing, eating, getting in and out of bed, or just moving safely around the house. Most long-term care happens in three settings: at home, in an assisted living community, or in a nursing home. And here's something interesting. About 70% of people receive care at home, which makes sense because most of us want to stay where we're comfortable. An assisted living facility is a step up when someone needs a little more help, and nursing homes are for when full-time medical support is needed. Now, the cost of care in the Bay Area can really surprise people. If you hire a home care aide, say 10 hours a day for most of the month, that can easily run around $10,000 a month. Assisted living facilities are usually less because you don't get one-on-one care all the time, but nursing homes and memory care facilities can reach $18,000 a month. And it doesn't stop there. Care costs go up about 5% a year, which means they could double in the next 20 years. Women tend to need care longer than men, about 5 years on average versus 4, simply because they live longer. And for someone with conditions like dementia or Parkinson's, care can last 6, 8 years, or even more. A big question people have is, who actually pays for this? Unfortunately, health insurance and Medicare don't cover long-term care. They'll pay for hospital stays, surgeries, or rehab after an injury, but they won't cover help with daily living expenses. The only government program that pays for long-term care is Medi-Cal here in California, or Medicaid in other states. But Medi-Cal only pays for nursing homes or limited home care, not assisted living, and only if you are low income. So in many cases, families end up paying out of pocket or providing the care themselves. And that can create a lot of stress financially and emotionally. The good news is there are better ways to plan ahead so your savings stay protected and your family doesn't have to take on that burden. There are really three main kinds of long-term care solutions: traditional long-term care insurance, hybrid long-term care insurance, and long-term care annuities. Let me walk you through how each one works. Long-term care insurance is kind of like a bucket of money you set aside for care. If you ever can't perform 2 of the 6 activities of daily living, or if you have a cognitive issue like Alzheimer's, that bucket starts paying out to cover your care. You choose how big that bucket is, maybe $100,000 or more, and how much you'd like to receive each month, say $5,000. The policy pays that monthly benefit until the bucket runs out. With policy options, you get to decide things like how much inflation protection you want, so your benefits grow each year, and how long you're willing to pay out of pocket before your benefits begin, kind of like a deductible. Traditional long-term care policies are pure insurance. They are great for people in their 40s or to early 60s who want strong coverage and like the idea of having leverage, paying a small premium to protect a much larger amount. The only downside is that premiums can rise over time, and if you never use it, you don't get the money back, sort of like car insurance. For example, this Lin and Trang bought a policy about 20 years ago with 3% inflation protection. Their original $500,000 benefit back in 2005 has now grown to $900,000 now, giving Trang nearly $19,000 a month for care. That's the power of inflation protection. Now, hybrid long-term care insurance is one of the more flexible options. It combines life insurance and long-term care coverage into one plan. If you ever need care, it pays monthly long-term care benefits just like a traditional policy. But if you never need care, your family receives the life insurance benefit tax-free. The great thing about these plans is that the premiums never increase, and they're easier to qualify for people who are older or have health issues. One of the most compelling features is you can fund them with money from different taxable assets, such as a 401k, IRA, or an old life insurance policy. One couple I worked with, Gwen and Jan, who used $100,000 from an old life insurance policy to buy a hybrid plan. If they ever need care, they'll each receive $5,000 a month per person for life. And if they never need care, their kids will receive $120,000 tax-free. So either way, that money is going to good use. Another strategy, which not many people know about, is using taxable retirement funds to pay for long-term care insurance. Let's look at two friends, Oscar and Felix. They both have $2 million in their taxable retirement accounts. Oscar decides he has enough to self-fund his long-term care if he ever needs it, while Felix is more risk-adverse and uses $125,000 from his retirement account to buy a hybrid long-term care policy. Both portfolios earn the same 6% yearly return, and they are in the same effective tax bracket of 20%. A few years later, they both need long-term care. Their long-term care expenses are $15,000 per month, while their general expenses are $5,000. Oscar pays for everything out of pocket around $25,000 a month for 4 years, while Felix's long-term care policy covers part of his costs, so he only withdraws about $16,000 a month. After 4 years, Oscar's 401k balance drops to about $1,170,000, while Felix still has about $1,560,000. That's nearly $400,000 more for Felix just by planning ahead. Now, let's take a look at how Felix actually did this. He reallocated $125,000 from his retirement account to the insurance company, but instead of just moving the money over directly, they placed it into a special annuity that automatically funds his hybrid life and long-term care policy over time. Now, you might be wondering, what about the taxes? Well, here's where it gets clever. Instead of Felix having to take that full $125,000 as a taxable withdrawal all at once, the insurance company spreads it out over 10 years, so Felix only pays taxes on $12,500 per year, not the entire amount up front. That keeps his tax bill smaller and a lot easier to manage. And here's a bonus, literally, the insurance company actually gives you a 25% bonus on your life insurance benefit just for using retirement funds to fund the policy. On top of that, depending on how the plan is structured, Felix may even be able to use the contributions for a tax deduction plus use the premiums as his required minimum distribution. So in the end, Felix gets tax-free long-term care and life insurance benefits, keeps his taxes low, and adds a potential tax deduction, all while getting more value from his money because of that 25% bonus. It's a really smart strategy, and honestly, one that even a lot of financial advisors don't realize exists. But when you do it right, it can make a huge difference in protecting your retirement and your family's future. Now, for people who might have some health issues or are a little older, there's another great option called a long-term care annuity. These are ideal if you don't want to go through a medical exam or worry about strict health qualifications. Instead, it's just a short phone interview, and based on your answers, you can qualify quickly. Here's how it works. You put in a lump sum, say $100,000, and depending on your health answers, that amount could double or even triple for long-term care purposes. If you never end up needing care, your money doesn't go to waste. It keeps earning about 3% interest, and whatever's left goes back to your family when you pass away. Let's look at an example. Ethel and Bob both have some health conditions that made it hard for them to qualify for traditional or hybrid long-term care insurance. They managed to save up $100,000, but they know that won't stretch far if either of them needs care. So they decided to leverage that money with a long-term care annuity. After a simple phone interview, no exams, no waiting, they were approved within days. Now, their $100,000 immediately turns into $300,000 of long-term care coverage. And if they never end up needing care, that same $100,000 keeps growing at about 3% per year, and when they're gone, it passes to their kids. It's a simple, efficient way to turn existing savings into 3 times the protection without the medical hoops or long approval process. And one last thing worth knowing, the government actually encourages people to plan ahead by offering tax deductions for long-term care premiums. If you're self-employed, part of an S-corp, or even just filing individually, you may be able to deduct part of your premiums. And if you have an HSA, you can use that to pay for long-term care insurance too. So that's a quick overview of how long-term care works, what it costs, and some of the most effective ways to plan ahead. If you'd like to find out which options you might qualify for or how to use your own assets in the most tax-efficient way, feel free to book a time on my calendar or just reach out by email or text. I'm Michael Wong with Long-Term Care Resources Pacific. Thanks for watching, and I look forward to helping you protect your future and your family's peace of mind.